Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments.
All right, let's jump right into it. What you're about to hear is based on the U.S. market analysis for Tuesday, March 31st, 2026. This explainer presents a direct informational narration of the source document. Okay, so here's how we're going to break this down. We've got 6 sections. We'll kick things off with the big picture, the market's core message. Then we'll get into the macro drivers and see how different sectors performed. After that, we'll do a deep dive on some key stocks, pull it all together into the day's main story, and wrap up with a look at what to watch for next. All right, let's get started. Section 1, Market Conclusion and Core Message. So what was the real story today? Well, the source material is really clear on this. The market wasn't just rallying on some vague good news. The core trade, the actual mechanism, was about something called a retracement of war-related risk premium. Think of it like this. That extra layer of fear that had been baked into prices, it started coming out. And that had a domino effect. It pushed oil prices down, it pulled long-term bond yields lower, and that, in turn, sparked a valuation repair for tech stocks and other similar assets. And you can really see just how broad this move was. I mean, look at the numbers. The S&P 500 was up 2.91%. The NASDAQ? It jumped a huge 3.83%, and even the small-cap Russell 2000 was up 3.4%. So the big takeaway here is that this wasn't just a handful of mega-caps doing all the work. No, this was a genuine, broad-based, risk-on kind of day. So if we were to rank the drivers for today, it really boils down to 3 things, in this order. Number 1, the big one, was that change in geopolitical risk. Number 2 was the direct consequence of that, the drop in oil and long-end treasury yields. And then number 3, that was the follow-through, the rebound in risk appetite that specifically helped repair those really beaten-down AI-related names. Okay, on to Section 2. Let's dig into the macro drivers and policy shifts that were really working behind the scenes today. Now, this is pretty interesting. The main driver today wasn't strong economic data, not at all. It was all about a shift in expectations around a possible off-ramp to the war. And what's the economic picture behind all this? Well, it's actually looking a bit soft. Sure, consumer confidence for March ticked up to 91.8. But, on the other hand, February job openings fell to 6.882 million, and hiring actually dropped to its lowest level since way back in March 2020. So what does that tell us? It suggests today's rally was about relief, about easing valuation pressure, not some newfound belief in booming economic growth. All right, Section 3. Here we're going to break down how everything performed, from the major indexes to different assets and sectors. You can think of today's action as a kind of transmission path, a real chain reaction. It all started with Step 1, expectations of geopolitical de-escalation. That led to Step 2, the risk premium in oil started to come down, which led to Step 3, a lower 10-year yield. And that was the green light for Step 4, a repair in those long-duration assets like tech and semis. And finally, Step 5, you see it right in the leadership from QQQ and SOXX. And if you need any more proof, just look at the sector performance. The story here is crystal clear. You had your classic risk-on sectors just flying. The semiconductor ETF SOXX was up a massive 6.13%. Biotech, the XBI, surged an incredible 7.58%. Now compare that to the defensive, safe sectors. Consumer staples, XLP, were basically flat, up just 0.10%. I mean, it doesn't get much clearer than that. This was a textbook risk appetite recovery. Okay, time for Section 4. Let's do a deep dive and look at some of the key stocks. We're going to run through the analysis pretty quickly here, focusing on the main points for each one. First up, NVIDIA. And wow, what a powerful rebound from some pretty oversold conditions. So what was the trigger? Well, it was that big macro shift we've been talking about, the repricing in oil and yields. There was also a Reuters report about a $2 billion investment in Marvell that helped. So when you classify this move, it's really a combination of valuation repair plus a rebound in sentiment and positioning. Now, for the numbers on NVIDIA. It closed at 174.4, so the key levels you're watching now. For support, you've got a zone between 170 and 167. For resistance, the first hurdle is between 175 and 181. A break above that would be a really important signal. And you see this same theme of technical repair with other big names too. Take Microsoft. It also bounced from a deeply oversold state, closing at 370.17. The classification here is pretty much the same, mainly a valuation repair move.
Keep an eye on support at 365 and that resistance zone between 372 and 375.
Moving on to Google, it also had a really strong rebound, closing at 286.86. But again, it's still operating within what we'd call a medium-term repair framework. It's primarily about valuation repair. The key levels to watch are support down around 282 to 278, and then that big resistance test coming up between 287 and 290.
All right, let's talk about Tesla. Its rebound was a little different, driven more by pure sentiment and positioning. It had that classic high beta, high elasticity bounce, closing at 371.75. But on a medium-term basis, it's still considered the most fragile of this group. You've got support at 366 down to 362, but a major resistance wall right overhead at 374 to 375. Apple was a bit more of a steady eddy today. It had a relatively clean and steady repair move higher, closing at 253.79. This one was classified more as a straight valuation repair. The important levels here are support between 252 and 250, with resistance up at 255 to 258.
And Amazon, it had a moderate repair move, closing at 208.27. But this one's at a really meaningful decision point. Why? Because it closed right around its major moving averages. So what it does next is going to be very telling. Support is 205 down to 203, and that key resistance is between 210 and 212.
Last but not least, Meta. This one was a real standout, a powerful rebound that made it one of the strongest big platform stocks of the day. It closed at 572.13, and this move was a mix of both valuation repair and a big sentiment rebound. For levels, you're looking at support from 563 down to 550, with the next big test at resistance between 574 and 580.
Okay, that brings us to Section 5. Let's pull all these threads together now and look at this session's core narrative.
So what was the bottom line, the core trade for the day? It was basically the reverse of everything we've been hearing lately. That whole narrative of higher oil, higher inflation, and more hawkish rates, that got completely unwound today. And the evidence is everywhere you look. First, the oil proxy ETF BNO, it declined meaningfully. Second, the 10-year Treasury yield dropped back towards that 4.31 to 4.33% range. And third, those high-duration assets we've been talking about, QQQ, SOX, NVIDIA, they were the ones leading the rally.
And that brings us to our final section, number 6. So, where do we go from here? Let's look at the outlook and the investment thesis. So to figure out if this repair can continue, here's the watch list for the next session. Number 1 and 2 are no surprise. Oil prices and the 10-year Treasury yield. Those are still in the driver's seat. Third, we'll want to watch the relative performance of equal weight and small cap indexes to see if this rally has broad participation. Fourth, the dynamic between semis and software, SOXX versus IGV, will be a key tell. And finally, number 5, we need to watch those key levels we just talked about for NVIDIA, Meta, and Google to see if they hold. And to wrap it all up, let's finish with the one-sentence core thesis straight from the source material. It really says it all. Today, the U.S. equity market did not trade a generic positive headline. It traded a valuation repair in long-duration assets triggered by the retracement in geopolitical risk premium, lower oil, and lower long-end yields. And that is the absolute key to understanding today's session.